Catching up on old GACs. Nothing really to report. I am trying to figure out what/where I am going to put my Roth IRA contribution for 2021. The market is so hyperinflated right now. It almost feels irresponsible to buy anything at these levels. But then again, with current fiscal and monetary policy the way it is, current tax policy the way it is, the incoming Treasury Secretary and the incumbent current Fed chairman, the market could go even higher, which is kind of scary, just because we're so far past where we were and should be based on the actual economy in the pandemic, but just shows you the power of the Fed. I don't know. I'm not sure where I'm going to put my Roth IRA contribution, but I'll figure it out. I'm sure there will probably be a pullback in January. There often is, because ordinarily we have a fourth quarter rally, and then things usually pull back or at least get reallocated in January. So we'll see what happens. We'll see what the market action looks like this week. And then maybe I'll figure out what or where to put my annual Roth IRA contribution. This Padme battle went south real quick. That's unusual. But whatever. Yeah, things are really expensive. If you haven't gotten into the market yet, wait for first quarter pullback. I think. I think, much like after the Great Recession of 07, 08, 09, I think that a lot of people are going to be hunting for dividend yields, because generally speaking, companies with good dividends have healthier balance sheets. Generally, not always. There are plenty of companies that have dividends that they, at least currently, cannot afford to pay, and therefore will end up cutting their dividends. So if that's the case, expect to see sharp declines in price action, in share price, if a company announces dividend cuts. There are also a lot of funds that exclusively have companies that have raised their dividends every year, or sometimes every quarter, but really every year, because who raises their dividend every quarter? I mean, that's really insane. That's just not sustainable, even in normal times. But yeah, there are plenty of funds that only include stocks that raise their dividends every year. So any company that doesn't raise their dividend or cuts their dividend will be dropped from those funds, which will also therefore result in a negative price action. So be wary of that. I mean, a lot of companies are still not issuing forward guidance because they don't know what's going to happen, which is fair. Number of companies have cut or suspended their dividends, so be careful with that. Rose. But yeah, I think that generally speaking, a lot of people are going to hunt for dividend yield in the short term, because that shit is generally a lot more stable and safer than a high flyer that has thinner margins and doesn't have as much cash on hand. Those companies, those growth companies, are good because they put most of the money that they earn back into the company for R&D or whatever. I mean, yeah, you just have to weigh your options. I mean, there are a lot more things that go into it than just that. I mean, that's obviously an oversimplified account of everything, but you have to carefully weigh your options. If you see a company that's dividend yield is like 8 or 10%, that's probably not sustainable. And a lot of the companies that do offer that kind of a high yield or energy, some real estate investment trusts, there are a couple of smaller mezzanine loan companies that offer those kinds of high dividend yields. Just be careful of them. I would much rather get, 2% from, I don't even know what's yielding 2% right now, because so many companies are the share price is so inflated. And then when a share price goes up, the dividend goes down because it's based on that. Let's take a look with my other phone. Apple's dividend is now 0.62%. Caterpillar, even with their great price action, is 2.25%. Costco, 0.75%. Disney suspended theirs, I think. Home Depot's 2.25%. Microsoft, 1%. Damn, Microsoft had like a 4% yield when I first bought it. Verizon is like an ATM. You're not going to get much of anything in terms of price action gains, like share price gains. It's pretty stable, and it's got 4.25% yield. So I literally use a company like Verizon, where they have at least steady cash flows, although they're not going to grow their business. I mean, they're not really going to die anytime soon. And you get a 4.25% dividend yield. So, I mean, you can use that as an ATM, do automatic reinvestment, and if you leave it in there, your interest will just compound and compound and compound. I see something like Verizon as akin to almost like a certificate of deposit in a bank. Except a certificate of a deposit in a bank, you're going to get maybe 1/10% or 1/4%. Verizon, you're getting 4.25%. So, I mean, sure, there's a little bit more risk involved with Verizon, but I think that's worth it, in my opinion. And a lot of people ask me, how much should I put in? How much should I invest? And my answer is only put in what you're comfortable with. Whatever you're comfortable not touching for a while, or even theoretically losing. Not that you won't lose it if you invest smartly over the long term, because you really have to invest long term, especially as a beginner. You don't want to try and day trade because you don't know what you're doing. There are plenty of veterans that don't make the best day traders because, you really have to invest for the long term. And that's why you don't invest in something that you don't believe in long term. That's why I rarely allow myself more than one speculative stock. This year, my first spec of the year was Moderna. I got lucky on that one. And I sold it. I bought it and sold it twice. So I actually made a good bit off of Moderna. But that was a spec. Moderna had never had an established vaccine come to market. COVID is their first, really. with new tech, no less. So that was a pure spec play when I bought it, and I bought it in mid March. And then after I got out of Moderna, I bought Caterpillar, even though it's a established company, been around for a very, very, very long time. At the time when I bought it, the climate was definitely not conducive to owning an industrial. I bought it on spec that industrials will boom, rocket back to life once COVID ebbs a little bit. I bought Cat on spec that maybe we'll get an infrastructure bill in the next few years, hopefully sooner. And I got lucky. I think I bought it between 95 and 105, and it's like 170 something now. So I got lucky on that one. Don't try to find and chase the next, big thing, because that's how a lot of people get burnt. That's how a lot of newer retail, millennial, and Gen Z investors get burnt. They try and chase something that's on a roll, like Tesla. One of my friends at work, he every time he's tried to buy Tesla, he ends up losing. So he's just given up on it. Look, sure, long term, if you buy a Tesla now, are you going to make money on it? Probably, hopefully. But it's just, and I've said this before, between Elon Musk being half a crazy person and the fact that Tesla burns through cash and just did another offering, yeah. Look, I think EV is here to stay. I mean, that's academic at this point. I don't really think that any of the current EV players are going to take enough market share away from Tesla. Maybe Apple, but that's a long way away.